It's the 15th of September 1992 in the financial district of Lower Manhattan, New York City. George Soros is in his office on the 33rd floor of 888 7th Avenue, which had been the headquarters of Soros Fund Management for the past 22 years. He picks up the phone and dials the office of Stanley Druckenmiller, one of his sub-asset managers. They get into an argument over the $1.5 billion bet Druckenmiller made against the British sterling pound. It was an enormous bet, as the quantum fund he was managing had just $3.3 billion of assets under management. But Soros wasn't angry because the bet was too big. He was wondering why they hadn't gone bigger. The next day, Soros borrowed the equivalent of $7 billion of the British sterling pound and exchanged it for the German mark currency. Soros and Druckenmiller had unwavering confidence that the British pound was going to collapse in value. And when it did, Soros became the first person to make more than $1 billion in a single day. But this trade, while one of the biggest success stories in financial history, is tethered to an insane series of events. A tale of how a secretly recorded interview in Frankfurt, Germany triggered one of the biggest financial crises of all time, known as Black Wednesday. An hour-by-hour battle between traders like Soros speculating on currency exchange rates and the Bank of England trying to stabilise the pound. This is the story of how George Soros and Stanley Druckenmiller broke the Bank of England. As you might imagine, these videos take an enormous amount of time to put together, and that wouldn't be possible without our fantastic channel sponsors, today's of which is Morning Brew. There are so many things going on in the finance world all the time, and before I became a religious reader of Morning Brew, I didn't really have a way to break through all of the noise, particularly on social media. Morning Brew is a free daily newsletter for busy people and busy professionals. They condense the most important business news into quick, witty stories that make it easy and enjoyable for anyone to stay informed. The newsletter is delivered to your inbox every morning, and I've personally been using it to stay up to date with current events that I might want to cover in YouTube videos. Like this story about the cost of single-family home ownership rising 26% since 2020, which inspired one of my favorite videos to date. And again, it's completely free. There's already more than 4 million professionals reading Morning Brew. It takes 10 seconds to sign up, so there's absolutely no reason not to try it. Sign up for Morning Brew today by clicking the link in the description or heading to morningbrewdaily.com/Hamish. It's the 13th of March 1979, one of the most important days in the history of Europe. Countries in the region all operate with their own unique currencies. France with francs, Germany with the Deutsche Mark, Ireland with the Irish pound, and so on. As each of their domestic economies expanded, so did the volume of cross-border trade. And this posed a significant challenge, trading in a dozen or more different currencies that fluctuate at different rates based on the respective economies. The 13th of March 1979 marks the day the European currency unit became operational. In of itself, it wasn't a currency, but it formed the basis of a new monetary alliance between 8 member states: France, Denmark, Belgium, Luxembourg, Ireland, Netherlands, Germany, and Italy. A cooperation that would stabilise European currencies and pave the way for a unified European currency in the future. This was the creation of something called the European Monetary System, and a major part of the agreement was the establishment of something called an exchange rate mechanism. The ERM essentially pegged the 8 different currencies to one another. Each country's central bank would be responsible for keeping their country's currency rate within a specific range. Take the French franc, for example. It was still in essence a floating currency in that its value was dictated by supply and demand. If the French economy was doing well, then there would be money flowing into the country through investment, and that increased demand for the currency would drive its price up. But under the European exchange rate mechanism, the rate needed to be kept within a particular range so that it didn't deviate too much from the other European currencies, which is where the Central Bank of France, the Banque de France, played its role. If the franc was getting too strong, then the central bank would sell lots and lots of that currency in order to increase the supply and decrease its rate. And vice versa. If the currency was too weak, then they would use their foreign exchange reserves to buy more of the currency, increase the demand and therefore its rate relative to the other European currencies. A central bank can also change the value of a currency by changing interest rates. Raising interest rates would incentivize more buying of a currency because you can earn a higher return on bonds and other assets, increasing the value of the currency. And lowering interest rates incentivizes selling of the currency, decreasing its value. The new monetary system created a number of problems across Europe. Beyond their primary goals of providing a stable jobs market and maintaining steady growth, they now had to monitor financial markets obsessively to keep their currency within the agreed range. A challenge that would later open the door for Soros and Druckenmiller to make one of the greatest trades of all time. It's October of 1990. Margaret Thatcher was serving her third consecutive term as Prime Minister of the United Kingdom, and despite considerable pressure, had resisted joining the European monetary system, which would peg the sterling pound to the currencies of neighbouring countries. She could see that joining would create an impossible task for the Bank of England, which would have to simultaneously strengthen the pound and stimulate a quickly deteriorating British economy. But other members of the Conservative political party she led saw things differently. And with her power weakening within the party, she finally conceded. The United Kingdom became a member of the exchange rate mechanism. The United Kingdom joining the ERM was a transparent display of the problems created by a currency peg of this nature. The year they joined, 1990, Germany was in the process of re-establishing as a unified sovereign state. The west of Germany had been booming under capitalism, while the eastern region was considerably behind in economic terms. The newly unified Germany used its economic strength to borrow and invest in the development of eastern Germany. And as the German economy expanded rapidly, their currency, the Deutsche Mark, became stronger and stronger. At the same time, the United Kingdom had fallen into recession. The end of the Cold War and an oil price shock had hit many Western economies, including the United States and other European countries. This put the Bank of England in an impossible situation. They would love to lower their interest rates to stimulate the economy. Lower rates would reduce mortgage payments for households and lower borrowing costs for businesses, which would help the UK return to growth. But lowering interest rates would also weaken the British pound, as the rate of return you could earn by holding British bonds would be lower. And the central bank couldn't let the pound decline in value, because it would slip outside of the range dictated by the European exchange rate mechanism. But not only was the UK unable to use their tools to stimulate the economy, they actually had to do the complete opposite. As Germany's currency got stronger and stronger, it became an anchor for the currency agreement, dragging up the target rate for the other 11 European countries. Between 1990 and 1992, the British pound frequently hit the bottom end of the target range, and each time the Bank of England was forced to buy more pounds with its foreign exchange reserves to prop up the value of the currency. As time went on, it became clear that this was an unsustainable path. If the British economy was ever to find its way out of recession, it needed to be able to let its currency fall in value. The question every trader was trying to answer was when? In August of 1992, Stanley Druckenmiller initiated a bet against the British sterling pound. He was working under George Soros in the Quantum Fund, where he could build relatively small positions. If Soros thought a trade made by one of his sub-managers was promising, then he'd become involved in increasing his firm's exposure. Druckenmiller bet the equivalent of 1.5 billion US dollars that the pound would devalue, that it would go down in price. And this type of trade is called a short position. Here's how it works. Soros would first borrow some British pounds, in this case about the equivalent of $1.5 billion. So now he had a loan in British pounds that he had to pay back at some point in the future. He took the British pounds and used it to buy the German mark currency. So he's now exchanged his British pounds into the German mark, but he still had to pay back that British loan at some point. The hope is that the British pound decreases in value relative to the German mark, so that when he exchanges his money back into pounds, he has more than the value of the loan he originally took out. He'd then pay off the loan with some of his pounds and keep the difference as profit. Now that the bet was in place, all they needed was a catalyst. Something to start an avalanche of British pound selling, enough to force the UK to leave the European exchange rate agreement. And it didn't take long for that catalyst to arrive. It's the 15th of September 1992. A journalist from the Handelsblatt newspaper sits down for an interview with Helmut Schlesinger, the president of the German central bank. He completes the interview and believes that he is now speaking off the record when he makes a vague comment about the European currency problems. He says that a wider devaluation of the Italian lira and other currencies would have been helpful to Germany. What the president of the Bundesbank didn't realize was that his remark was recorded on tape. Werner Benkhoff, the journalist, recorded the comment with the belief that this was part of the interview, and he prepared to publish the story all around the world. This was the catalyst George Soros had been waiting for. Leading up to this notorious interview, Italy had also been struggling to maintain its currency strength to stay in the exchange rate mechanism. On the 13th of September, the Italian lira had fallen 7%, and anyone holding onto the currency had lost a lot of money. So the fear of a British pound devaluation was beginning to grow. And while somewhat vague, a statement from the German central bank that these other currencies needed to fall further could be enough to start a cascade of selling. On hearing this news, the British government urged Germany to deny the statement before it hit the news cycle, but they couldn't, because the comment was recorded. It's the morning of the 16th of September. Rumours of devaluation are now circulating in full force. For large institutions like hedge funds and pension funds, there was really no reason to hold on to the pound that day. There was no upside, there was only the risk of holding it. So everyone started selling their pounds. Soros took the Bundesbank comments as his cue to go big with his firm's short position.
And we took our cue, actually, from the Bundesbank.
He increased the bet to the equivalent of $7 billion as well as $500 million invested in British stocks. The nominal value of this bet was bigger than the total assets under management in the Quantum Fund at the time, but only required an upfront collateral of $1 billion. The $500 million he invested in British stocks also likely pay off if the pound is devalued. British companies exporting goods would earn more in pound terms, and higher domestic prices would lead to higher stock prices. And it wasn't just Soros. Many traders were participating in the same trade, betting that it would decline by borrowing pounds and selling them. And so began a financial fight for the ages. The Bank of England needed to defend the pound by buying lots of it. They could do this by using their foreign exchange reserves, £19 billion worth of gold and other currencies held by the government. When the market opened, the Bank of England decided to use its foreign exchange reserves to buy £1 billion. But there was so much selling that it evaporated in minutes. It made no practical dent in the value of the pound, and it continued to slide. They realised that buying British pounds wasn't going to be enough to stop the decline. They needed to use their other lever, raising interest rates. And this was very controversial. The UK already had an interest rate benchmark of 10%. Increasing the rate any further would be punishing to households with mortgages. The Bank of England sought approval from the Prime Minister, who agreed to raise interest rates from 10% to 12% at 11 o'clock in the morning. But the interest rate rise had the exact opposite effect. A 2% interest rate hike is significant, and it indicated, particularly to traders all around the world, that the Bank of England was becoming desperate. so many traders began doubling down on their bets. By midday, the Bank of England was now burning through £2 billion of their foreign exchange reserves every hour. At this pace, the country's foreign exchange reserves would be completely depleted before the end of the day. In a final act of desperation, Prime Minister John Major decided to raise interest rates again, this time a 3% hike, raising the benchmark to 15%. But it didn't work, and the pound continued to fall throughout the afternoon. The Bank of England had now spent a shocking £15 billion and was running out of money. It was now inevitable. The UK would have to leave the exchange rate mechanism. They could no longer defend the pound. And it went into free fall until the markets finally closed for the day. Ultimately, the British sterling fell by 15% against the German marks currency and by 20% relative to the US dollar. Soros and Druckenmiller made $1.5 billion from the trade in the month of September 1992. If you enjoyed the video, consider hitting subscribe, and here's 2 other videos I think you'll like.